Mics are hot. Boom.
Ouch.
Ew.
Hello, everybody. I know we're running a few minutes late here, but we're just going to cut this countdown timer off and just get rolling. You guys ready?
Yes.
Ready as always.
Let's do it. I see Travis has got his pumpkin spice latte. Where's your avocado toast?
Listen, I tried to get the salted caramel cold brew, but apparently Starbucks has discontinued it and already thinks it's fall, even though it's 90 degrees here. So.
Management at Starbucks is ready. They're ready for September 1st.
They're on it.
They're like, let's bring the pumpkin spice holiday cheer.
Hey, you know
up
what?
in this bee.
You know what they're also on?
What?
That Bitcoin.
Oh, yeah?
What's
Yeah.
the latest?
Well, let me see if I can find the tweet here. This is in El Salvador. This is the Bitcoin payment kiosk. You can see they've got, it's kind of hard to see with this little reflection, but they've got the prices like $20, $10, like to the closest 100 sats. You know, Bitcoin is still kind of difficult to use as like a unit of account just because the decimal place is so annoying. But once Bitcoin gets to $1 million, then it'll be, you know, it'll be a lot easier to use as a unit of account. How's everybody doing, guys? Welcome. If you're watching live, thanks for being here with us. If you're watching or listening to the podcast or the video after the fact, thank you guys as well. Also, cheers to Y Charts for sponsoring the show. They've got some dope fundamental analysis for anybody who likes to do research like these nerds. Yeah,
We are.
Guilty as charged.
Fundamental analysis nerds.
that's right. So, dude, we've got so much to cover today. So much happening in crypto. The stakes are bigger than they've ever been. And yeah, let's just go into it.
All right, let's do it.
Okay, so first order of business is Coinbase, right?
Well, I don't know.
No, that's
actually
not the first
no.
order of
You know what?
business.
Before we dive in,
Okay.
I gotta whip out my very cool spectacles. You guys remember
Man.
these things? This is the first gen. Trav actually bought me these back in the day.
Yeah.
Super dope. I think I used them twice on the boat. I was afraid to get them wet. But yeah, what's happening? Facebook. I thought this was kind of a interesting and creepy thing to actually kick the show off with, but Ray-Ban and Facebook are partnering together to create some new glasses that look almost too good to be true, almost too real to be true. I don't know. What do you guys think of this?
Yeah, it's very creepy. I actually watched the social experiment that this reporter did on this. She went around and just started filming people, and nobody knew that they were being filmed. So
Yeah.
you couldn't tell because they've made the camera really, really blend in with the glasses. They've made the LED light that's supposed to pop on when you're recording very small. So it's nobody could tell.
Yeah.
Very inconspicuous
Yes.
design, right? Like, so I guess it's controversial because this is the future of people having the ability to film people so easily without them knowing. But the flip side of that is it's also kind of a cool thing as you've probably messed around with the spectacles because you can film things hands-free, and then you can get that, you know, different viewpoint, like a GoPro type point of view. And so there are some cool things about it. And eventually, I guess Facebook wants this to be more of like an augmented reality type of situation where you can scan something and take a picture of something and maybe it pops up and you can shop for it or whatever. Who knows what the future holds. But yeah, I think that they look really good.
They look too good. I don't know, Trav. Is this creepy or is it cool?
Both.
Yeah.
Very much so.
Yeah.
I think, you know, similar to the spectacles, like you, I probably used them a handful of times. And so I think this iteration, while the big advance here, obviously, is that they've made them look cooler and more sleek.
I don't know,
think these
man.
don't look cooler?
I think these look pretty dope. I don't know. What do you guys think?
But, you know, this is the precursor to Facebook's, you know, fully augmented reality types of glasses that they're working towards, the AR glasses that they're going to be building in the next few years. And so I think with with the next few iterations, we'll start to see it become more and more interesting and perhaps integrated into our daily life and commerce and all kinds of cool things. But it's still going to be creepy, and there's still going to be all these privacy concerns. And Facebook says that they're working with all these privacy groups, but like I think like 80% of them are like mostly funded by Facebook.
Yeah.
And so it's kind of like, well,
That doesn't really count.
yeah. And yeah, I think it's going to be an interesting, next few years. In fact, I mean, I think I said this before, but we're going to be fighting this privacy battle for the rest of our lives.
Yeah.
And probably our children's lives and our children's lives. So, that's the push-pull here with tech, is that, it just becomes more part of our daily lives, and it also becomes like more entrenched as a potential like tool to like take away liberty. So like,
Good point.
I don't see how the privacy battle will be won by the people. Like, honestly, I mean, technology is going to take over in so many ways, and take away the privacy that we have, if we have it at all right now, right? I mean,
it's going to take a very concerted effort on every person's part. And the reality is most people don't give a shit, right? Most people don't care about privacy.
Yeah.
But when they realize, oh, there's three things. There's privacy, anonymity, and security. And all those are very different, and all those matter in so many ways. I'm super bullish on any company that develops tools and resources to help people take control of that stuff over the next few years. I think that's going to be a huge movement. There's always going to be that segment of people that just don't care. But I think more and more people, like with all these data leaks and all that stuff, are going to start caring. And they're going to be like, no, I don't want every person that walks by me with these sunglasses on to record me. I don't know.
I guess eventually what the technology could look like is we are all put in these databases that we can search the database and find like facial recognition, and it'll find us.
Yeah.
And we'll be able to see like all of the videos that we somehow got put into.
Yeah.
And maybe control it that way.
Interesting.
Kind of a crazy thought.
Yeah.
But
All right. Well, look, we're facing a creepy future, but right now we're also facing a creepy reality. Today, speaking of people overreaching and creepy things happening in the crypto space, this was the front page of the Wall Street Journal today, everybody. Coinbase says this is kind of a lame headline. Really what happened is the SEC is saying that they're going to sue Coinbase for their upcoming product launch, Lend. And, there have been fireworks. There have been a lot of back and forth. There have been a lot of finger pointing over the past couple of days since this broke. But for anybody that hasn't seen this, Brian Armstrong, the CEO at Coinbase, basically did a tweet storm and talked about their side of the story. They also put out an official blog post from their chief legal officer talking about what happened. And you've even got people like Mark Cuban that are stepping in and making their opinions heard about this. And for some reason, let's see, I don't know if this is keeping up. Anyway, just a lot of weird stuff happening. And the biggest thing that, I kind of wanted to say is what we've been talking about the past year about how there has been such regulatory uncertainty, and like it almost feels like the regulators are being intentionally vague and intentionally disengaged with the community. And that really, really sucks. That's a not good thing. What do you think, Trav?
Yeah, I think there's so many different facets to this. The way that the SEC is treating Coinbase, the way that Coinbase responded late at night in these tweet threads instead of behind the scenes working with the SEC. Like, there's just a lot here to unpack.
Yeah.
But I think, I'm pretty critical here of the SEC from the standpoint of why are you coming after Coinbase in arbitrary ways instead of working with them behind the scenes? If Coinbase is going to be, one of the companies in the US particularly that has been, trying to basically do the right thing over time, whereas there's other shady exchanges that, definitely break the rules and break the laws. I mean, Coinbase is in some gray areas for sure, but like they have tried to be that exchange that tries to do things that are above board, right? And so it's sort of in bad faith for the SEC to just unilaterally go after Coinbase. they sent him a Wells notice, which is a pretty serious deal. It basically is a notice that says, we're about to take enforcement action against you. Now, in the SEC's defense, the Coinbase Lend product is almost certainly a security.
Yeah.
Coinbase is saying like, oh, well, we don't think this is a security. I mean, basically any lending product, whether it's a bond or a loan or anything similar, is always going to be considered a security under the eyes of the traditional securities regulators. So they shouldn't be that surprised. But, you know, it's really frustrating when you have this new SEC under Gensler, and we had this, you know, completely feckless SEC under Jay Clayton when, you know, we had the previous administration, and they did nothing.
Yeah.
They hardly went after anyone for anything, and there was just a golden age of fraud, right? And now Gensler said, well, we're going to start to actually do things again at the SEC. Okay, that's generally good. Let's go after, you know, the frauds. Instead, they're choosing to pick fights and act in these like weird ways, right? And it's like, well, why don't you actually listen to the people and the investors here? If you're claiming to protect investors, why don't you listen to investors? Why don't you work with the companies that are clearly doing something right and getting lots and lots of, you know, new customers, you know, in the doors? Realize that you can't like fight innovation. Work with them behind the scenes or whatever you need to do to try to bring these things into being while also protecting people, not like just going after them and playing political games. I don't know if any of that made sense. I'm kind of on a rant here, but
Dude, keep going. I mean, all that was beautifully said. And I think some people in the crypto community, you know, they don't understand that, yeah, the Lend program maybe is a security. Like
Yeah.
we don't know some of the conversations that have happened behind the scenes. All we know is that Coinbase and Brian Armstrong in particular is saying that they're not getting any response. We don't really know what's happening behind the scenes, but we would hope that the SEC would be more responsive. And it does seem a little bit weird that they've chosen to go after Coinbase and Uniswap.
yeah.
Okay. I mean, I also saw today that they're suing a couple other like smaller scams, but like really, like that's who you're choosing to spend resources on right now.
Yeah.
And instead of being proactive, and like Gensler was the guy that I remember a few years ago thinking, oh, he might be a good guy to have in the helm of the SEC because he is so pro crypto. But I don't know. It's frustrating as hell to say the least.
Yeah. And we've talked about a lot how the SEC uses this shield of investor protection. And it's like, really? Because we've had Chinese frauds raising capital in the U.S. market for the last decade. You've done nothing about those. You've let the Chinese frauds raise billions, tens of billions of capital and essentially wipe out capital from all these other investors.
Yep.
You've done nothing. You've had all these insiders do really shady things with insider transactions and insider trading. There's even insider trading with Congress. You've done nothing about that. You've done nothing about Ponzi schemes. And yet you're going to go after, you know, a firm that's trying to innovate and trying to do things in, you know, for the most part in the right ways. And so that's really frustrating. Also, the stuff like angel investing we've talked about over and over.
The
right?
accredited, you know, they've paid lip service to the accredited investor rule, but there haven't been any major changes there. So U.S. investors have gotten left behind a lot in crypto, and it's been frustrating as hell. And I was hoping that this year things were going to get better, but it seems like the U.S. is headed in the wrong direction.
Yeah. Is it no wonder that, you know, that the SEC will, you know, try to keep the little guy? I mean, is it no wonder that the little guy is going into crypto? The average retail investor is embracing crypto because they can finally earn reasonable yields. They can finally get access to early stage projects. You know, because otherwise they've been shut out of venture capital largely.
Yep.
They've been shut out of the best investments of the last 2 decades, you know, outside of public equities and maybe real estate. And it's like, is it any wonder why they're adopting crypto, right?
Yep.
I have a theory. I could be completely off on this, but you guys tell me what you think. I had thought that maybe this is a major threat to the banks because Coinbase is a trusted, publicly traded firm now, right?
Yeah.
Like now people are more willing to put their money there and keep their money there. So if a firm like Coinbase comes out with a 4% yielding product, I would imagine that a lot of money would end up sweeping from traditional banks into Coinbase. And so I thought, like, could the banks be like putting the pressure on the SEC or something, you know, something going on there? I could be completely off.
No, it makes
on
sense.
that, but
yeah.
It's just something that came to mind when I was reading through this today. And I guess for Coinbase to avoid the issues that they're running into now, they would really need to become a bank to be exempt, because banks have lending accounts. Like, you put your money in a savings account, and guess what? That money the bank takes and it lends out to people, and it pays you interest in return for using your money. It's the same thing, but they have exemptions for being a bank. They're regulated as a bank. And so I guess like I wonder if the path to Coinbase being able to do this is the SEC saying, hey, you want to be a bank? Become a bank. And I don't know if that's something that they'd ever be willing to do.
Coinbase does not want to become a bank.
They don't want to become a bank. Yeah, exactly. So I don't know. It was just a strange thought that came to my head.
I think there's, at some level, absolutely a lot of truth there.
Because they are more trusted. Like,
Right.
people are probably way more likely, your mom and pop investor, they're way more likely, if Coinbase offers a 4% quote unquote savings account, okay, a lot of people are going to want to put their money into it.
Yeah.
So
maybe then, if we're playing devil's advocate, maybe it does make sense to try to make sure that something like that is bulletproof, as bulletproof as you can make it before opening the floodgates. Because think of that. We're in a world right now where there's a shit ton of cash
and no
chasing yield. Yeah.
None.
Yeah. I mean, what are the banks going to do with their high yield savings? What are they now? I don't even know. Are they 1/10%? Or
maybe
10
25 basis points.
25
maybe
basis
a quarter
points?
of a percent.
Yeah. So like Coinbase has the opportunity to really create a flood of capital.
Hell yeah, they do.
Yeah.
I mean, people would be chomping at the bit for 4%.
Yep. Triv, you're smirking. What do you think?
I don't know. Speak.
Let's go.
Speaketh.
Let it flow.
I've already gone on my rant here.
Okay.
I guess I'm just frustrated yet not that surprised the way that how the SEC is acting. As an institution, the SEC has been so poorly run for the past 10 or 20 years, and I just don't know what fixes that.
I wonder if they got Kim Kardashian on pumping shit coins, or Cuban and Elon for pumping Dogecoin. None of that gets talked about.
Exactly.
Sorry.
Yeah.
Elon literally
No.
committed securities fraud in broad daylight on the largest scale possible, and yet is still out there running all kinds of scams.
Oh yeah, the
real
420,
companies too.
The
Yeah.
420 thing.
Yeah, the
too.
fake buyout.
Yeah, the fake buyout.
Where he literally committed securities fraud, and then he told the SEC to,
SEC.
that's right.
Yeah.
And what happened?
Nothing.
Yeah. I mean,
So.
there at some level you have like now the untouchables, and then you have the innovators in the crypto space that are now becoming the quote unquote bad guys. And you've got even like Senator Warren and some of these other politicians that are out there like pointing the finger at Bitcoin. Oh, look how much energy it uses. It's evil. See, guys, it's no good. There's scams everywhere. It's evil. It's bad. Stay in the regular banking system, the traditional financial system. You can trust it. You can trust us.
This is
what
a
they're doing.
war.
This is war.
Traditional banking versus crypto, essentially. I mean,
Yeah.
that war's been going on for a long time. But now...
It's heating up.
Now, regulators are starting to F with people's potential money, right? Like,
Yep.
the mom-pop investors' ability to do something like this savings account or lending program with Coinbase.
Yeah. All right. So how does this play out? All right. Let's talk about the 3 Ps. Guys, for anybody who's not in our community, this is how we look at investments. This is how we weigh decisions, is what we call our 3 Ps. We look at the possibilities, everything that could possibly happen, or like the major possibilities, the probabilities, what we think is most likely to happen, and then plans. We create plans around all of those possibilities, probability weighted, right? So what are the possible outcomes here, guys? Obviously on the extreme negative side, we have a super heavy-handed regulatory bodies in the US. You got all of them competing for control, and it's very heavy-handed, and they basically stifle innovation. DeFi leaves the US more than it already has. Traditional crypto, let's call it Gen 1 crypto, is screwed here at some level. On the other side, you have like a complete reversal of the SEC where they backtrack and they do become more friendly. I give that a low probability. And then there's that playground in the middle. I don't know. What are the other possible outcomes?
Yeah, I think an obvious outcome with a reasonable probability in my mind is that Coinbase and the SEC come to some kind of agreement at some point where Coinbase maybe has to halt the lend product, maybe even delist some assets, frankly, to try to avoid getting, further sanctions. And then they can kind of work through some slow regulatory process where they eventually are able to offer more of the products that they're trying to offer. It just takes longer and is more costly. That tends to be the path anytime you have to work through the SEC. And Coinbase has enough money now that they're public, they can probably go hire some expensive lobbyists. Like, this is the game that everyone likes to play in Washington, D.C., and that's the game that Coinbase is going to have to play, probably. And that's why I think also a lot of people were critical of Coinbase with Brian Armstrong, and the Coinbase account on Twitter themselves went out and did those tweet storms the other night, kind of railing against the SEC. And typically, you don't want to make the SEC your enemy in that kind of a process. So I think a lot of people had criticism of that maybe Coinbase should just be quiet and work behind the scenes. I don't hate on that, the way that Coinbase did it. They probably were just very frustrated. The SEC wasn't really responding to them, and so they really didn't feel like they had another option. But
yeah, what do you do if they won't respond to you, right? It's kind of like, okay, we either quietly fight this battle, or we know that the crypto community is large and vicious, and like we can stir the pot maybe.
Yeah, I think it actually is not a bad strategy to maybe at least show the SEC you've got some clout and some, common man behind you, so to speak. And then you go play that game of, we're also going to hire expensive lobbyists, and we're going to try to figure out whose pockets do we need to grease to, make this process a little smoother for us. But in the end, it's probably also going to mean that Coinbase is at a disadvantage relative to some of the other offshore providers who are going to step into the void. So
yeah. We've been talking about this for years. The fact that if the U.S. is heavy-handed, capital and talent is going to flee the U.S., and we're seeing that. And I hope it reverses. But I wanted to pull this up. So Mark Cuban, who is no stranger with dealing with the SEC.
That's right.
He said the worst case is that the SEC gets a judgment that cripples crypto and DeFi and moves it even further offshore, killing possible trillions of dollars in economic benefit for the USA. I couldn't say that any better. Like, that is absolutely the risk is now trillions of dollars. And we need exemptions like the internet got in the 90s. Call your congressperson. I mean, people need to realize how much is really at stake right now.
Mm-hmm. Yeah, I do think he said that very well.
Yeah.
Yeah.
Let's see. What else did I pull up around this? I think that was mostly it.
If we're putting a message out there about all this, maybe it's that we should stop electing 70 and 80-year-olds to our federal government.
That would help.
True.
They don't understand technology. They're not going to be ahead on innovation. And frankly, I think we could use some younger blood, even if it means it's 40-year-olds or 50-year-olds.
We need Congress. Gen X to step up.
Yeah.
Somebody, right?
Let's go. Gen X, millennials, let's go.
Millennials might be a little more well-versed in this kind of stuff, on the crypto side,
yeah.
right? Like, but millennials are the crypto people.
Yeah.
And then everyone else is kind of just learning.
Okay.
They were the OGs.
we were there in the beginning.
Millennials were the OGs.
That's right.
Yeah. All right. Well, okay. Let's talk about how this affects price. I know this is what a lot of people want to talk about.
Yes.
Price. All right. So, a couple days ago, Bitcoin. So, okay, let's back up. So, over the past month or so, we've seen Bitcoin up, about 80%, I think? Yeah, about 80% from the pivot low around 30,000. And then we topped out a couple days ago up around 56. And we've barely had a pullback during that time. We had about a 10% pullback here in early August. And then it's just been kind of a grind. And one thing that tends to happen is when you're testing major resistance levels and the markets are already up a lot, the higher you go, the bigger the risk of a deeper pullback is. That's just the way the markets work. Markets don't just go straight up in a line. And I actually tweeted this when was this, 2 days ago? I said, Bitcoin loves to take the stairs up and the elevator down. Why? Well, because people pile into, I said leveraged longs on resistance breaks, but you don't even need that word leveraged. Really what happens is people just buy. They pile in during resistance breakouts, and then they stack their stop orders below support. Okay, and so what that does is when price tends to retrace and pull back to retest support, it creates this fast waterfall of selling. Okay, so it's kind of like everybody rushes for the exit at the same time, and it clears the order book out. You get this really violent, fast, high volume pullback. And I said, backtest how many times this has happened over the past decade. Like, we have seen this over and over and over and over again. And then, you know, there were some comments in here, you know, Willie Woo, really smart guy. He was chiming in about, you know, open interest and funding rates well within norms. That's fine. Like, I maybe shouldn't even use the word leveraged in here. It's trader behavior. And so again, when markets go up a large percentage and you're testing prior resistance around all-time highs, the market doesn't just get through that easily without a pullback. And so as of right now, we've got a retest from this pivot low of the 38% Fibonacci retracement, and buyers are trying to hold above this 200 period moving average. So I'm not surprised to see a little bit of support kicking in here. But I think it's important for people to understand why price action does what it does. And the most common thing that Bitcoin loves to do is what we call phobos, or fake out breakouts. It's very, very common. And if you trade on leverage specifically and you keep really tight stops, you're probably going to get your stops run and taken out, and then you're going to see the trend either continue or chop around. But the biggest lesson here is just to keep price in context of where it has been in recent history. So when it's up 80% over the past month or 6 weeks, and there hasn't really been a pullback, expect a deeper pullback, right? Things like that. Like, when people look at this price action, a lot of newer traders tend to look for like the magic indicator, or like the one thing that will just predict what price is going to do. But that's why we talk about our 3 Ps, right? Possibilities, probabilities, and plan. And to remove or like demystify the boogeyman behind the price action. Like, there was a lot of people saying, oh, this is manipulation. There's an attack on Bitcoin. There's, you know, back in the early days, we used to call it Spoofy the Bear Well. You know, people used to be like, oh, Spoofy's out again. You know, there's always this like scapegoat that people love to use and say for reasons why price went down. No, it's market participant behavior that causes this shit.
I mean, the FOBO is classic across all markets. Happens every day.
Yeah.
And so what Bitcoin did is pretty, like you said, it's very common. And I think that it did have a pretty nice move from those lows that you would almost want to expect that a pullback was going to come eventually.
Yeah. Absolutely. And somebody just commented, they said, it's not everyone rushing for the exit, it's the exchange liquidating margins. Yeah, that's the exchanges forcing everybody to rush for the exit. It's like being in a movie theater,
right?
And they kick the lights on and they say, hey guys, there's a fire in the lobby. You guys have to go for the exit. We're forcing you to go for the exit. So whether it's somebody capitulating emotionally and pulling their stop too close and getting that run, or getting margin called because they don't understand how to use leverage in a healthy way, or if it's, you know, some other just weird dynamic, it's people all selling at the same time, which creates that waterfall of selling. And it's usually when things look the most bearish and the most scary is usually where the bottom is. Look at the panic of March 2020, you know, when everybody was freaking out and price went from basically 8K to 4K in a day or two. We were there getting greedy as everybody was rushing for the exit. So if you want to be a successful trader or an investor, or even if you're not really a trader, but you want to get your timing and your average entries a little better, do the opposite when there's high emotion on both sides of the market. When it's panicking, when it's going parabolic, right? Take the opposite side of the popular opinion.
It was actually funny. What was the pullback? Like It was, what percentage was it exactly?
Around 20, wasn't
Around
it?
20.
Yeah.
I remember getting a notification on my phone on that day, and I was like, Bitcoin pulls back 20%. And then, you know, some markets in turmoil headline, right?
Yeah.
And I'm just laughing my ass off internally because I'm thinking to myself, hey, people just don't realize, like, coming from the stock where like a 20% correction in stocks would be like the end of the freaking world.
Yeah.
But a 20% correction in Bitcoin is like, oh, I like shrug up.
That's an
20%,
average
like, that's
Tuesday
like,
afternoon.
It's like nothing,
Yeah.
you know. Like even looking at the chart, like it still isn't that significant on the in the grand scheme of things. Looking at the range
Yeah.
from the bottom to where it's at now, it was just funny.
Yeah. Oh, somebody was also asking, what's a FOBO? I don't know if I explain this. So FOBO is fake out breakout. It's where you get the breakout of a resistance area, and then you get all these buy orders. And then when the buy orders dry up and everybody pulls their stops in and it starts to pull back, those stop market sell orders start to get triggered. And that's what causes that flood of selling very quickly. You can see it on the order book. You can see it in real time. Maybe one of these days I'll try to catch it on a recording and then like narrate through and talk about what happened. But that's what it is. Fake out, breakout. FOMO, so FOMO is fear of missing out. That's usually what causes people to buy in and buy tops. But I digress.
Well, people probably FOMO'd into the breakout and then it FOBO'd
Yeah.
on them.
And look, I was adding into this, and even in my trade alert, I said, look, I'm actually expecting a trap, and like I'm prepared to buy back lower. So there's always this balance between possibilities and probabilities,
Yeah.
right? You can buy believing it could go, but being prepared to buy lower if it actually pulls back.
I would
It's
say,
like a chess player. Like you think 2 or 3 steps ahead of where the market is today.
yeah, I would say even so, the more seasoned trader is going to be thinking more so it's going to FOBO than it's going to actually work.
Yeah. And well, it depends on where you are. Like if you're coming off of an 80% upside move without a deep pullback,
yeah.
the odds of a FOBO are much,
Makes
much
sense,
higher.
yeah.
If you're coming off of 6 to 12 months of bearishness and
Yeah.
it's the first accumulation range breakout, yeah, that's very high probability.
Yeah, that makes sense.
Yeah. All right, cool. Let's talk about something that I think is super interesting in the crypto charts. Total 2. Okay, so if we look at the total market cap of all non-Bitcoin cryptos, you can see we're just coming off of a double top. So right around 1.4 trillion. And again, I want to use a little caveat here and disclaimer saying market cap is not necessarily the best way to value the entire crypto ecosystem because it's a very easily manipulated statistic, but nonetheless, it can give us clues into what is happening. And after having a very deep pullback in the altcoin market, over 60% over the past few months, we've rallied back to all-time highs. And we've had some altcoins make new all-time highs this week. We've had some that are still over 50% off of their all-time highs. So right now we have a very mixed bag, which I think is actually a very good thing. When you start to see, you know, some tickers like, what was it? Today was Algo. Over the past couple of days, Algo broke up and is up pretty big over the last 48 hours. When you start to see what we call as popcorn season, where things are moving independent of Bitcoin, that's what we really like to see. Here's Cosmos, at the ticker's ATOM. I'm still holding a runner on this. Back testing all-time highs, right? You've got some of the gaming cryptos, AXS, you know, coming off of all-time highs after having epic runs. And then you've got some of the older stuff that I can't believe I'm about to call dot older, but you've got some that had a massive run in Q1 that are still quite a bit off of their all-time highs. So we've just got this very diverse ecosystem right now, and I think that's a really, really good sign. My guess, and again, I'm not saying that this has to work out, but my guess is that the altcoin season is not over. I think things could get a lot more parabolic and ridiculous than they even are today. Now, if something happens like a black swan event and Bitcoin just crashes hard, that could pull most alts with it. But I don't know, just looking at everything as a whole pie, taking everything into consideration, I don't think the party's over yet.
Well, that's good news.
Yeah, what do you guys think? Everybody in chat, you guys think the party's over? Or are we just getting started? Or is it midnight and everybody's a little tipsy but still ready to keep going to the early morning?
Is there a website that like organizes different coins into like sectors? Like, you know how in the stock market we've got sectors of the stock market, and it's very easy to delineate between, you know, the different types of stocks that are out there. But I feel like in crypto land, and obviously I'm not a crypto expert.
Yeah.
But okay.
Masari does that.
Okay. Yeah.
Yeah,
There we
there's
go.
a few.
Like,
I
I
mean,
want to know like what are the different categories what's the purpose that these coins hold, and
well, I can tell you the purpose for me, for 99% of altcoins, the purpose in trading altcoins is to accumulate more Bitcoin. That's purpose number one. And then I hold core positions in a few others, but you know, I'll trade these volatile assets and accumulate more fiat and more Bitcoin that I can trade in and out of and grow wealth that way.
So you mentioned gaming coins, you've mentioned privacy coins, you know, all of these different types of DeFi coins. Like, where can I see the breakdown of all of those different things?
Right here. So yeah, I've got different watch lists that I save. So, you know, you've got privacy coins like Monero and Zcash. Got, you know, stable coins. You've got coins that, you know, just trade on dexes like Uniswap.
Right.
Yeah, I mean, there's many different sectors, which is what's great today. And what I love about crypto today compared to 2013 is that today we've got way more liquidity and a way more diverse market participant pool, meaning there's more people around the world, there's big funds, there's tiny investors, and everything in between.
If you click on an asset in Masari, I believe it will show you Masari's breakdown as well of what type of what category. Like if you go scroll down a little bit, it'll show you like I think scroll down a little bit more.
Yeah, we've got sector right here, token type. Yeah, I mean, and there's several websites like this out there.
Okay.
But
And then it'll even show you peer coins, like so peers down here.
That's what I need.
And it'll sometimes tell you, it'll tell you kind of what's in its category.
Okay, so I'll mess with that site. Good to know. Thank you.
All right, let's see what people are saying. Steve was saying bearish September, mania in the fall. Tiago's saying second wave coming. Jay had a question. We'll get back to that. CoinGecko does sector. Yeah, there's a bunch of websites out there. I don't know. I think things are just really taking a pause. And we saw this in 2017 where we had a spring altcoin season and then a fall altcoin season through the end of the year. We'll see what happens in 2021. All right, cool.
To the moon.
Moving on. So let's talk about some positive developments. Enough of this regulatory shit. Let's talk about El Salvador and how that's going. So we talked a little bit when we were kicking off about the little Bitcoin terminal here at Starbucks. I thought this was super cool. And then they basically have little devices that they can scan the QR code, and they're doing business. I mean, they're doing transactions. They gave away Bitcoin to a bunch of citizens. You got McDonald's here saying you can pay with Bitcoin. I can't tell you how cool this is to see this actually happening. This was always the expectation, right? That large either franchises or just large businesses with a ton of stores would roll out this ability. I never thought like it would actually happen in a place like El Salvador first, though. I always thought it would be the U.S., but I guess it makes sense that something like this would happen.
I mean, it has the most impact in emerging markets, right? I mean, the unbanked, essentially. So I guess it does make sense that this is happening there before it happens here.
Yeah, you don't have a lot of other infrastructure when it comes to payment processing and things like that. There's not as many, Square-like terminals at small businesses.
Exactly.
So everyone's got a phone, probably a smartphone, starting to have high smartphone penetration. So you have all the ingredients for this to make sense.
So the network can handle this. The Bitcoin network can handle individuals using it as a currency?
A lot of the transactions are being done on a second layer.
Oh, okay.
Like what is it, Strike or
Yeah,
think
like
you're right.
basically, so you've got second layer solutions on Bitcoin that today make it more scalable.
Okay.
And then you've got competing coins which are trying to get a piece of that pie, and I'm for both. You know, I'm not just even though I am an old school Bitcoiner, I'm not a Bitcoin maxi that says that Bitcoin is the only way, right? If another coin comes along and does a better job at a medium of exchange than Bitcoin, so be it. Bitcoin doesn't have to be the everything to everybody all the time, right?
Yeah.
But this is an interesting experiment, particularly because El Salvador uses the dollar and Bitcoin, right? So, and there are several other Central and South American countries that also have that structure, or at least have the dollar structure. So if it succeeds and the local adoption is big here, I think we're going to see a rapid adoption across all those other countries. They're going to be in a race to catch up with this.
Man, I hope Bitcoin goes up for these people.
Yeah.
I really do. I just want to see people build wealth.
Hell yeah.
And if,
that's
like,
why we're here.
You know, if the government is giving them Bitcoin, and if they're going to be more apt to buy Bitcoin, to be able to transact in it and hold it, like, that's a big deal.
Yeah.
For a lot of these
This
people.
is why we're doing all this, right?
Yeah.
This is what the community is all about. It's like, yeah, sure, it's cool for us in the U.S. that already have access to banking services to get even richer, but let's help these people.
Yeah.
Yeah. Awesome. All right. Well, let's move on. So we've talked about so far the SEC debacle. We've talked about Coinbase, talked about Bitcoin's prices, talked about some altcoins. Let's talk about some of the economic stuff, which is going to have direct consequences on money and the economy and all that good stuff. So what is this next? Senate Democrats eye taxes on stock buybacks.
Yeah, I think that this is something that came out, I think, last week or early this week. I can't remember. But this is kind of ridiculous, I think, personally.
Yeah. If this happens, what does that mean for investors?
I don't think it's likely to happen.
Okay.
But basically what the government would be doing is taxing stock buybacks, you know, on the corporate level.
Potentially raising hundreds of billions of dollars from about 600 of the richest Americans.
But there's essentially going to be a double taxation in play here.
Yeah.
You know, and I don't know if that's necessarily fair. I think
like
that companies would be more, they would be more likely to just issue dividends in that case versus doing stock buybacks.
Yeah.
I don't know. I'd be curious Travis's take on if you're even concerned about this.
How do you even tax unrealized capital gains? Like what does that even look like?
Oh, well that's ridiculous. Yeah.
These are all horrible ideas.
Horrible ideas.
These are all horrible ideas.
Like the Democrats are they're just pulling.
They're
Yeah.
scrambling.
They're just
Yeah.
So do you think this is just lip service and there's like no chance that it actually passes?
It's hard to say. I think there are some of these ideas, pay-fors as they call them, essentially tax increases to try to pay for the big spending packages. There's probably some of them that could get bipartisan support, but not the more extreme ones like taxing unrealized gains. I see that as very unlikely. Just because of the complications, the nightmare that would result from an accounting standpoint, IRS, capital flight, all of those unintended consequences would be very severe with something like taxing unrealized gains. So that I think is pretty unlikely. The stock buyback stuff gets raised all the time. Nothing ever seems to get done on that. I think that would be a stupid idea. There's really not a big difference between a stock buyback and a dividend. And so you're essentially, raising taxes on dividends or raising taxes on buybacks. It's not a great way to raise money because corporations, what they'll do is they'll just shift their capital allocation. So when they're running the numbers on the amount of tax revenue they think they can generate from stock buybacks and dividends, it's unlikely that would actually come to fruition if they did pass those, just because corporations will just shift their capital allocation policies.
Yeah.
So again, I think these are all very bad ideas. the Democrats are in a weird place right now because they've only got about, in my estimation, about 8 to 9 months to get things done before midterm election stuff starts to kick in. So the midterm elections are still slightly more than a year away, but they will start preparing for midterm elections probably next summer, and there won't be very many legislative packages pushed through in the couple months leading up to the midterm elections. And I think the Democrats are at a pretty high probability of losing seats and losing one of the chambers of Congress in the midterm elections. And that's a pretty typical pattern of the last few election cycles. So what does that mean? They've got a very short window to get their legislative priorities done, and any kind of extreme new tax increases are going to be very difficult to achieve. So if they want to get their legislative packages done, they're going to have to get all the moderate votes, and all this stuff, I think, goes out the window.
Gotcha.
We'll see.
Yeah.
All right, we'll keep an eye on that. But in the meantime, I want to ask you guys, since we are all such huge fans of investing in bonds, let's look at the 10-year yield today.
I like my money.
Yeah. 1.297 on the 10-year. Since we're such huge fans of investing in bonds, Nikki had an idea here that I saw you tweet out. She said, maybe Apple really is the new bond. The stock price is relentless. Could it be that people have no idea where else to put their money besides a financially secure behemoth that is, 1, paying a dividend, 2, buying back stock, and 3, growing revenue double-digit percentages? That's an interesting take. So what are you saying? Basically, people are bailing on regular bonds and looking at some blue chips as the new bond?
This came to me because I was looking at Apple's stock price. I'm a shareholder in Apple, so I'm always looking at Apple's stock price.
Yeah.
And I noticed that the price was just very, very strong. A lot of relative strength compared to what the S&P had been doing over the past few days. And it got me thinking. I mean, Apple had broken out to new all-time highs. Price action looked super healthy. And I'm thinking to myself, shit, like maybe this is just where people are throwing their money because they don't want to put it in bonds, because bonds are crappy right now. You're not really getting any real yield on bonds.
Negative real yield.
You're getting negative real yield on bonds, and nobody likes that, right?
Yep.
So, I mean, Apple truly is a behemoth, and it's very financially secure, and they're doing all of the right things. And if people are thinking about where the heck can I put my money right now and it can actually work and do something, I mean, big tech is kind of the place right now, but more specifically, Apple feels probably your safest bet, if anything.
Is that true, though, or is there a lot of downside?
I mean, this is debatable, right?
Right. That's why we're talking about it.
All I'm saying is, when you look at it, they're paying a dividend, they're buying back stock, they're very financially secure, they're growing revenues like a growth stock. I mean, they've kind of got it all. So as far as valuation, that's a whole nother topic as far as if it's overvalued, undervalued, or whatever. But I was just thinking that maybe the price is being driven by people trying to chase something, trying to make some money, and not wanting to buy bonds.
What do you think of this idea, Trav?
Yeah. No, I think it's right. I mean, there is a linkage between equity yields overall and bond yields. And by equity yields, I mean, if you take the PE ratio and literally flip it upside down, instead of going P over E, you go E over P. That's an earnings yield. You could also do the same for free cash flow yield.
Yeah.
And you could also do the same thing for dividend yield, right? Some measure of, the amount of cash flow or dividends being generated divided by market cap, or a similar metric, will give you like what an equity is yielding. And that will almost certainly in most markets have some connection to the overall, yields, whether nominal or negative, in the bond markets. And so, yes, I do think ultra low yields have pushed people into even more so into blue chip stocks, and especially into some of these indices we've talked about, like, the NASDAQ index, the S&P. People reaching for yield, people especially wanting some of the safer stocks that have a dividend yield. So yeah, I absolutely think that's true. But to your question, is there risk here? I do think there's risk, because if we do see a regime change in inflation or things like that, or if interest rates have to rise, then, you know, these things become at risk, because you do have ultra high PEs and ultra low free cash flow and dividend yields. And so if yields start to rise, then these things can get crushed. So Apple, I mean, obviously Apple's fundamental business itself won't be crushed, but the stock price can either be flat or down for a long time if we enter into a new rate regime. So
is 60-40 dead? And if the answer is yes, does that mean that the 40 now goes into NFTs and spectacles? What do we do, guys?
Does the 40 go into Bitcoin? I don't know.
Yeah, I mean, like, so many generations have been taught, like, all right, you got to have your 60% stonks and your 40% bonds, and that's about it, right? Like, but now you've got, you know, millennials and Gen Z, which are like, all right, I've got several decades of potential wealth building, or I can buy stonks way up here and bonds way wherever they are right now, right? Like, what are the options? I think maybe
bonds
that is
way up here, right? 'Cause
yeah,
the yields are down or whatever.
I mean, is that why digital rocks are selling for $1 million and I'm wearing these ridiculous spectacles?
It certainly has something to do with
man.
it. It definitely has. I mean, there's capital out there with not a lot of places to go. I mean, yeah. I mean, why? I mean, how could it not, right? The question is, how could it not have some impact, and how could, you know, some of these new asset classes be benefiting? I mean, for sure, I definitely think that's a part of the, you know, part of the allure. And then, of course, part of it's just innovation and new cool shit and higher yields and DeFi and things like that, right?
I mean, everybody's navigating this together. Like, all the advisors, us as retail investors, this is all new.
Yeah.
You know, even advisors are like, well, shit.
What do we do? We need
what do I
to,
do?
there needs to be a new headline that's something along the lines of, kind of like that 2017 headline, everybody's getting hilariously rich in Bitcoin except for you. It needs to be, everybody's getting hilariously rich in NFTs except, and ICOs and DeFi, except for anybody in the United States that's under the SEC's purview. Like, yeah, there needs to be
slogan.
Or yeah, it's like, thank you, Papa, for, you know, protecting me against all the evil actors out there and keeping my capital safe. You know?
Yeah.
Oh man, what a weird time we live in.
60-40 is 60% Tesla, 40% Bitcoin. I thought.
There you
Isn't that
go.
the new 60-40, the millennial 60-40?
No, I think it's 60% Bitcoin, 40% alts, and yeah, you better be buckling up for some volatility.
With all of this said, let me just bring us back to reality.
Okay.
You can still diversify a portfolio.
Yes.
You're just going to be taking on a bit more risk.
Yeah.
That's all.
My portfolio right now is about 30% crypto, 30% stonks, and 30% cash, real estate, VC, all that other stuff.
Yeah.
I think that's a pretty good approach.
Yeah.
I mean, a 30% crypto position is high, but it depends who you're asking.
Yeah.
Right? Because, like, a lot of people you talk to, it's probably like 30%. That's not a lot.
Right.
I actually got a comment from somebody, or saw a question, I think, that came through someone that had 90% of their net worth in crypto.
Yeah.
So, I mean, it's all relative.
Well, and it's relative too. If you have $1,000 to your name and you got $900 worth of Bitcoin, that's very different than you've got 9 million.
Yes.
And, you know,
Yes.
So I don't know. It's all about risk tolerance too. Because I mean, look, if I had 90% of my wealth in Bitcoin and we had an 80% drawdown, I know I can't stomach that. Right, like my comfort level is 50%.
People can't.
Right.
Even the people holding it probably can't.
No, well, and that's the thing.
They just
Most people don't know. Yeah, you're right. They don't know the risk tolerance, so they're just cocky on the way up, and then when it crashes, they're like, "Oh God, I can't take the pain. Panic sell the low. I'm out."
Yeah.
Right. So you got to know yourself.
And there are three parts of analyzing your risk, right? Or your risk tolerance. There's risk capacity, which is your actual ability to take risks, meaning if you have no savings, you need to be a bit more careful, right? Versus someone who's got millions and millions. And then there's risk tolerance, which is what you actually can, what you think you can tolerate. Yeah. And then there's risk perception as well. And that's essentially like how you might be perceiving a certain situation could change your risk tolerance, quote unquote, over time. Like risk perception is what changes, but risk capacity and risk tolerance usually stays the same, right? Like that's set in stone. You know, you either can or can't take on risk financially and mentally.
Yeah.
But how you're perceiving things changes all of the time based on how the market moves. So sometimes you have to like understand that and manage it the right way as things happen.
Spoken like a certified financial planner.
I can't help myself.
We've got Tiago said 60% alts. Short Bus said try 130%. Yeah, why not just lever up? Just kidding. Look, there's a lot of crypto YouTubers that will pump these high leverage, unregulated futures exchanges. Be very, very careful. All right, let's move on. What is this? We've got the lowest level for unemployment claims.
We're trending in the right direction.
Yeah.
I think that this is great to see. One point about this was in relation to like, because I was thinking about the different sectors of the market, and I know that I mentioned as unemployment rates decline and we start to see the economy kind of come back, where in the market is there going to be opportunity? And I looked at it again, and I'm still thinking that travel and maybe financials are probably the places right now that might have something. Everything else to me is feeling a bit priced in, you know, for the recovery, quote unquote.
So what seems cheap?
Well, I mean, nothing. I don't know if I would say anything really seems cheap, but I would say the travel sector the travel industry is somewhere to look for opportunities. Like I was thinking about GoPro, for example, as an opportunity.
Ooh, that's a controversial one.
GoPro they do well when people are traveling and buying cameras to go travel and record all of their adventures, right?
Yeah.
And I was thinking, are they going to be a beneficiary of the reopening, like the global reopening? I don't know. It's just one to consider and think about. But
what about Airbnb?
Airbnb is still expensive, I think.
Still?
Yeah. It never came down to my level.
Yeah. Held support at 130s.
Yeah.
Trav, what's cheap, man? Where can we get some
cheap?
alpha? Let's go. Tell us what to buy in the stonks.
Everything. Do you feel like on a general level, looking at sectors, everything is kind of feeling a little bit priced in at this point? I know individually you can find things.
Yeah.
But on a broad scale, it's like if you're looking at sectors to invest in, where do you go right now?
Yeah, I mean, on a broad scale, U.S. markets in particular are quite expensive relative to, you know, historical averages. But again, it kind of goes back to being in such a ultra low rate environment where you can't actually get much, you know, positive real yield. It's pushed people into equities. It's, you know, it's sort of like logically it makes sense why it's happening, but it is frustrating. I think, you know, when you look at international markets, you have a lot cheaper other equities markets out there. I would say, you know, there's a lot of potential there. I mean, certain markets have governance issues. Like you look at Brazil and the average equity trades for a single digit earnings multiple, and you're like, wow, that's interesting. But then you see what's happening or what has happened on the governance side, and there you're like, well, I kind of see why. There's a lot of risk there.
Yeah.
You talked last week a lot about China, and even on your own live stream, you were talking about that. I saw Paolo said Chinese stocks are cheap. Yes, they are, and for a reason, right? A lot of risk tied to that right now.
Yeah. I would say you would need a higher risk tolerance to be able to deal with that regulatory risk.
Yeah. But I mean, there is a bull case there, right? Where the regulatory risk doesn't play out in the worst scenario. And then what is the bull case? Is the bull case like is there a strong bull case? And are you guys like looking at that as a higher probability, or are you just staying away altogether?
In Chinese stocks, particularly? I mean, I have one Chinese stock position, and I keep debating with myself whether or not I should just get rid of it. I don't want to have a ton of China-based exposure right now. You know, China's going through a pretty big upheaval with how they're treating their own companies. And then you've also got like this Evergrande weird thing going on in their market. it's definitely a heightened risk environment. And normally I would say that's not necessarily a bad thing. Like I go and seek out opportunity where risk, where there is risk and where there are sell-offs happening. But with China in particular, it's such a unique place because like literally something could be done overnight that wipes you out. That's very unusual. Like even in U.S. markets, we might see like, there's weird risks with single companies and things like that. But from a broad basis, there's really nothing like China. That is unusual and very, very risky in a way that, I don't really personally feel very comfortable with.
Yeah.
So I have a little bit of China exposure. I am going to keep that very limited just because there's just too many unknowns and risk of getting wiped.
They're just doing very weird things, like making billionaires disappear and come back looking shell-shocked, and deprivatizing or like making education nonprofit. What other weird things are there? I mean, the whole fact of like not even really owning the company, but owning like the Cayman Island structure instead. Like there's a lot of weird situations there.
Yeah. So this isn't just a normal like, Google's in a 20% correction, you should buy it because historically like that, you've made money doing that. No, this is like, do you even own equity in the real company? Could China tomorrow like invade Taiwan? Could they tell U.S. investors to go pound sand? Yes, all this could happen. Like it's not like you're not investing with the same parameters, that you are in developed markets. So that to me makes it a very unique set of risks, and I think you have to be really careful about sizing that any more than a very small position. And I have been getting lots of questions about that. All these stocks that are down a lot, that some of them have really good fundamentals, but there's just this external stuff you can't. How do you put probabilities on that? And we talk about probabilities and possibilities, and that left tail of the probability distribution is quite large.
Yeah.
And so that's the concern. But to answer your original question, about where there's cheap stocks, I do think, there are individual places like I think energy and some of the cyclical sectors like home building, energy and home building still look very cheap. And if you believe that, the economy is going to continue to be in an okay place, I mean, there are stocks selling at single-digit earnings multiples and free cash flow multiples in those sectors.
And we need to build a lot of houses to catch up with the demand.
Yeah.
This isn't like the last housing boom where prices were high and there was an oversupply and all this speculation. It's like people want homes and there's not enough.
Yeah.
But there's also the affordability crisis too, where it's like if rates do start to creep back up, that puts pressure on prices. But people still, I think, are going to be buying homes, right?
Yeah. Yeah, I mean, although I should say, today, or not today, but this week, Pulte Homes came out and said, we're going to build less houses in the third quarter than we had previously projected because of supply chain issues. So
wow.
In the short run, maybe that's why they all trade at 7 times earnings, because, the earnings may not be growing because
they can't deliver.
They just can't put the buildings up in time.
Yeah.
But
at least lumber came back down. I haven't looked at it in a while. Have you guys looked at lumber in a couple
I
days?
think it was trading in the 500-600 range, so it did bottom out and start to recover a little bit, but
it's wild that it's actually so red on the year. Let's see. It was down like 30%. Now it's down only like 16% on the year after being up massively.
Yeah.
That was a wild ride.
Yep.
If you're ready for the next wild ride in commodities, let me tell you about uranium.
Ooh, let's go.
Did we talk about
There we
uranium
go.
on the
We
show
have
last
not.
week?
We
I
did
can't
not.
remember. I know you talked about it on your channel, but
No, we didn't talk about it on the show.
yeah. Why don't you do a synopsis for the viewers?
This is crazy. So in the late 70s and early 80s, there was a cornering of the silver market. Really interesting thing that happened. The Hunt brothers tried to corner the silver market. Silver went up from, I think, $5 or $10 to $50 per ounce. And what is happening in uranium right now kind of echoes that to some degree. Uranium's a really weird, thinly traded commodity. Most of uranium doesn't even go through the spot market, or the spot or the futures market for that matter. You've got 3 big worldwide producers of uranium, and you've got, a couple hundred nuclear utilities worldwide that buy from the 3 main producers, and they typically buy on long-term contracts, but occasionally they have to buy some in the spot market. And unfortunately, uranium, the price of uranium has been in kind of a bear market for the better part of the last decade or two, because after Fukushima, if y'all remember the big Japanese nuclear disaster,
Yep.
Japan shut down all its nuclear reactors. So the demand for uranium kind of cratered. There was kind of ample supply of uranium. And so the producers of uranium were having to contract out their long-term contracts with the utilities at pretty low prices. I mean, uranium went from like almost $100 per pound in the early 2000s down to like the low 20s per pound. And
Here we go. This is, I don't think this is like spot uranium prices, right?
That's an ETF, I believe.
But it kind of tracks what kind of happened with uranium over the past 10 years.
yeah, it does generally track the physical price pretty closely. So yeah, essentially you've been in this bear market, but now the uranium market started to perk up a little bit for a couple of reasons. The uranium market's finally worked off a lot of the excess supply post Fukushima. You've got, the producers, the three main producers of uranium, trying to be a little more disciplined about supply. They're trying to get the utilities to contract at higher prices going out to like 2025, 2026, 2027 timeframe. And they're saying, look, you're going to need to pay us a little bit higher prices. So there's been some bulls in the uranium market over the last couple of years saying uranium prices probably are going higher in the next decade or so. Very slow moving market though, until this summer when Sprott, a commodities focused investment firm, has bought out an old trust that used to buy physical uranium, and they started converting it into like a closed-end fund style. So the Sprott Uranium Trust just a couple of weeks ago started buying physical uranium aggressively. And what's interesting about it is they pretty much are price agnostic. So when money flows into the Sprott Uranium Trust, they use that money to go out and buy more physical uranium in the spot market. Well, the spot market's very thin. And so with Sprott buying up and hoovering up daily, like sometimes as much as 500,000 to 1 million pounds of uranium, it's a significant amount of the supply that's out there in the spot market. Sprott is sending prices up dramatically in a short amount of time. So we're now at like $40 spot price for uranium, $40 per pound spot price from, the essentially 25 or 30 just a couple of weeks ago.
With a big gap.
Yeah.
Yeah.
And there is a thought here that Sprott's aggressive buying in the spot market is going to hoover up every available, pound of supply of uranium that's not contracted. And it could send spot prices to, I don't know, $50, $60 a pound, maybe $80 or $100 a pound like we saw in the early 2000s. And so that is going to have an effect on any uranium producers, utilities that have to buy any uranium on the spot market. So it's a really interesting situation. And there are some uranium-focused stocks out there that have been benefiting a lot already and could honestly double or triple again if we see uranium prices go north of $50 or $100 a pound.
Hell yeah.
So what lumber did last year and maybe early this year, we might see in uranium. It might go up like 2-3x.
So are you long?
I'm along a little bit of a uranium producer and thinking about getting longer, just kind of waiting to see if we'll get a little bit of a pullback because it's been going straight up for the past 2 weeks.
Nice, man. Yeah, not a lot of people even think about trading uranium or know anything about it. And all of a sudden, it seems like some of these commodity markets, you get a weird supply dynamic and then...
Yeah. And, people keep piling into the Sprott fund. If you bring up, I think it's u.un on TradingView or, you had it up. I guess you did have it. Yeah,
there we go. Nice. It trades on the TSX.
Yeah. So what's funny about this fund is it's in this virtuous cycle, kind of similar to the way that GBTC was buying Bitcoin, last year, where people were investing money into GBTC. So GBTC would go out and buy Bitcoin. That would make Bitcoin go up. So more people would be interested in buying into GBTC in this virtuous cycle. And the same thing is kind of happening here. So now like the Reddit crowd has started to pick up on the uranium trade. It's starting to become a bigger deal and be reported more widely. So now more people are getting interested, buying into Sprott, which causes Sprott to go buy more uranium, which causes more people to buy into Sprott.
It's the next GME.
Is it?
Let's go.
There is talk that the uranium prices could get nutty and parabolic, and I think it's possible. I will say, at some point, the utilities and the regulators start to go, wait a second, we've got a financial buyer in the uranium market. Like, maybe this isn't such a good thing.
Yeah.
And there might be some backlash. And,
Well, hopefully that distracts them away from crypto then.
Yeah, exactly. But that may not happen until we see north of $50 or $60 a pound of uranium, so.
All right. We'll keep an eye on that. Next up, all right, we talked about how, well, you guys talked about how everything is, not everything, but most things are expensive on average right now. And Nikki, you wanted to look at what, forward PEs and talk about valuations?
This was in relation to the conversation around the sectors. It would have been a nice visual while we were talking about it. But what we could move on to, if you scroll down, you'll see the chart for the PE ratios of the different sectors. And you can see kind of visually how high we are in certain areas in terms of where we've traded on average and where we
it's
are
at the
today.
upper end of the range of most of these
so
things.
like obviously the S&P 500 is trading above average, but so are a lot of other things as well.
Yep.
And this is where I was, bringing in just the visual to match what we were discussing.
Gotcha. Okay.
So you can move on from that.
All right, sounds good. Inflation. We have no inflation. Actually, who was the guy in the administration that was talking about food prices? Did you guys see this video clip?
Oh yeah, and it was like, oh, we don't have inflation unless if you exclude what people have to eat, like protein, beef, pork, chicken.
If you exclude beef, chicken, pork, we have no inflation, but just don't buy meat. Everybody go vegan. Yeah, that was pretty interesting.
Yeah. Well, today, I guess it was announced that the ECB is going to start pulling back on asset purchases. And when you look at where we are with the Federal Reserve and inflation in the U.S., and then ECB, and then inflation in the Eurozone, it's kind of funny because the Eurozone is making moves on monetary policy before the U.S. is, but the U.S. is seeing higher inflation.
Yeah.
So it's like, I don't know what's going on, or there's a lot to this that I'm probably not fully in tune with, but it was just kind of funny because the Fed is like not
asleep
doing
at the
anything. And we have way higher inflation than they do. So we'll see if the Fed actually ends up making a move on tapering asset purchases towards the end of the year. I think that the market is starting to look like the actual price action in the S&P 500 is starting to look a little concerned. Finally, I guess seeing the ECB do it, then maybe the market is thinking, oh crap, like maybe this is coming, and they're trying to prepare themselves, and maybe a correction is ahead. I'm not sure. There could be way more to it than that. The headlines are like COVID fears, blah, blah, blah. But I'm like, okay, the market's known about COVID. What's really going on here?
Yeah.
Right?
I mean, if you look at the price chart, like in the grand scheme of things, it still looks like we're in this extended bull market, or this extended bull range, I should say, bull run.
But the market finally looks like it might roll over here.
Yeah, it could. I mean, it's, I don't know. And until we get outside of this little channel, I have no idea.
Yeah.
From a technical basis, but you guys want to do some Q&A?
Let's do it.
All right. If you guys have you guys that are watching us live, feel free to throw some questions in chat. First question we got through the website. If you go to wetalkmoney.com and submit a question for the show, we could pull it up here in a nice pretty slide. Hayden was asking, hey, I'm 25 in California working a job in crypto that pays $70K plus a decent stock package. I've been hodling my Bitcoin and ETH since 2018. Congrats. Today worth about $500,000. I'm about 90% allocated. I know, scary, LOL. So
this was where I got it.
Okay,
yeah.
gotcha. And got the rest in stonks due to appreciation. But I don't want to sell and incur a ton of taxes. I've been trying to stack cash recently and am aiming to buy my first home and diversify. But I'm in no rush in this hot real estate market. Any recommendations on what my focus should be? Maybe moving to Texas is the play. Maybe to save on taxes. But you got to know, guys, we have really high property taxes here.
Yeah, you do.
Keep that in mind.
Yeah.
And very hot property markets.
And a very
Yeah.
hot property market. Yeah.
Maybe better off in California. I don't know.
Who knows? I mean, look, every other license plate I see these days is California. So,
Oh,
hell,
yeah.
I don't even know.
Yeah.
I don't know. How do we unpack this? So first and foremost, we should say we are not your financial advisor. So we can't give you personalized financial advice, but we can use this question as an example to give general
Yeah.
education.
Yeah, this is a good one. First of all, congratulations. I mean, that's great that you've been able to get that kind of net worth. And I think something that a lot of people freak out about when it comes to selling their assets is taxes, right? It's a big deal. But I've actually looked at like where your tax bracket is and tried to figure out a good response to this. And I think that if you really are looking to sell, you're probably going to be in about a 15% long-term capital gains bracket.
15%?
15%. Yeah, based on the salary you've given me, I don't have all of the details, but based on that, you're landing in the 15% long-term capital gains bracket. If you think about it, 15% is a pretty low tax rate. Like, I think a lot of people are afraid of having to pay the tax, but I think that 15% is a very, very nice tax rate to lock in today if you can. And so you're there. You've been holding since 2018, so you don't have to worry about that. You'll have that rate. And then as far as your actual marginal tax rate is, that's kind of low too, in the 22% range. So as far as taxes go, maybe try not to be so worried about that, and think about more so what tax rate you're locking in today and benefiting from the long-term cap gains.
And also, like, one thing I like to think about that I know Ramit Sethi from IWillTeachYouToBeRich.com talks a lot about is, like, also outside of the numbers, what are the intangibles, like your quality of life? Like, we don't know what city you're in. Like, you could be in a 400 square foot apartment in San Francisco with a bunch of meth heads knocking on your door every day. Who knows? So quality of life matters too, right?
Yeah.
We want to think about that. Like, where are you? What do you want to do? What would be the purpose of buying a home? Is it to just diversify, or do that because grown-ups have told us, to buy real estate, or is there a real purpose there?
And something that you can do to kind of help lessen the tax blow is maybe consider putting more money into, say, a 401k at work, which gives you a tax deduction, and kind of work that a little bit to help with the tax hit that you may get. And also consider not selling all of it, and selling it slowly. You don't want to sell a bunch of crypto and then be bumped up into the top tax bracket. Then your income's going through all of the tax brackets up to 37%, right? That's not ideal. The ideal situation is controlling your selling so that you stick within certain brackets and you don't go into those higher rates.
So maybe the advice would be is to hire a financial planner, figure out what that number is, right? Like, oh, you can sell up to this much and be in this bracket.
Yeah.
And then maybe even think of other ways to strategize minimizing taxes, because a lot of people don't know all the things you can do to minimize taxes.
Yeah, but unfortunately, like, as far as not paying taxes on it, with crypto, it's tough, and you can't really roll that. I mean, you could do an opportunity zone investment if you wanted to, but those come with their own set of problems and risks. So, yeah.
Trav, anything to add?
No, I think you kind of nailed what I was thinking about, which was, you can manage it where you maybe sell a little bit when you need it, or a little bit in a year where you have more deductions or losses on other investments, and try to like manage your tax burden that way. And then, I definitely wouldn't sell it ahead of needing it. Like, if you feel comfortable with your existing holdings, like, I don't know that I would need to sell a bunch of it unless you have identified a place where you want to invest that capital. One of the good things about real estate is if you're looking to, invest in that asset class, you actually could utilize leverage, right? You get a loan on a primary home of, 80 or 90% LTV, loan to LTV. So you may not even have to take out a lot to then make a property investment, depending on where it is. But
figure
that out first. Where do you want to live? You said maybe moving to Texas is the play. If you're thinking about, I mean, the advantage that Texas has over California from a tax perspective is no state income tax. But it sounds like income is not the main issue here when it comes to taxes. It's more of the capital gains. And so that's not going to change whether you're in California or Texas or anywhere else. So that question about where you want to live should almost even be a separate question here. You know, like think about your quality of life, like you were saying earlier. Where do you really want to be? Where are you most bullish on having a primary residence? And then you kind of like go through the steps there. And then the last step would be figuring out how much you need to sell based on all of those things first.
Yeah, great points. And Max Bro in chat had a good comment. He said you can also borrow against it. We didn't even go that direction. That is a possibility. There's risks that are associated with that too. So it's not for everybody, but that is an option that you could look at if you wanted to potentially save on taxes. I'm not a tax attorney, so you know, you definitely want to consult with somebody who knows the law before you do that. But that is a route you could go. Definitely. Is borrowing against it, still retaining the asset, but also just know what the risks are associated with that.
Yeah.
Cool. All right. Awesome. Next question. Darren was asking, what is the best number of individual stocks and cryptos to own when spread across multiple portfolios? I'm not exactly sure what that means as far as like spread across multiple portfolios or like what the ideal number is. For me, the ideal number is whatever opportunities come up. Like, I don't try to own 50 or 100 cryptos just to say I have a whole bunch of cryptos. And I also don't just own one or two because I want to keep it overly simplified. I'm like, where's the opportunity? What's my bankroll? How do I want to size these? And I go in with that. How do you guys think about stocks in that way?
Yeah, so there is no perfect magic number, but I will say when you think about diversification within a portfolio, and let's just talk about, like, let's say a stock portfolio first, because there's a whole lot of other considerations when it comes to putting together like a portfolio of multiple types of assets. But let's just say you're focusing on one type of asset and you're trying to diversify within that asset class. So let's say you're looking at a portfolio of stocks. How many stocks should you own? That question, like I said, doesn't have a perfect answer, but we know that diversification gives you kind of a free lunch. It's like almost the only free lunch in finance that there really is. And if you have stocks, at least a few stocks that are uncorrelated to one another, that can mean having a greater overall portfolio return than you would have in any individual stock, even adding stocks that are maybe less risky. The portfolio math there is really interesting, but the benefit of diversification starts to really drop off after about 10 to 15 stocks in a portfolio. So anything beyond like 20 or 30 stocks is going to be overkill from a diversification standpoint, because you're essentially just going to look like an index fund at that point.
Yeah.
So there's no real need in most cases for an investor to own more than 30, 40, 50 stocks in a portfolio. In fact, that could actually be a detriment because you end up just having a portfolio that has the same return as the overall market. So if you're trying to beat the market and you still want some diversification, the sweet spot tends to be somewhere between like 5 and 20 stocks typically. But again, it could depend on your risk tolerance, how you tend to size your core positions, and that may make a difference between holding 5 stocks and 25 stocks. And so you kind of got to figure out your risk parameters to know within that range what the right number for you is.
Great answer. Anything to add?
No, I think the number that they talk about is about 25. Like over 25, you start to look like an index, and it kind of is defeating the purpose a little bit.
Yeah.
I would actually say that's probably true in crypto too. Like maybe anything over 20 to 30, the answer is why. Like, what are you trying to accomplish? Is it a bunch of DeFi stuff that's kind of new and fringe? Okay. But if you're talking about some of the larger cap things, like, I mean, I would say over 50% of my portfolio, no, way more than that. 75% of my crypto portfolio is like less than 5. And then I've got the long tail of a bunch of other stuff. But yeah, I don't know. That's a good answer though. Like you don't want to diversify too much because then you might as well just buy the SPY. And then if you're overly concentrated, you're taking on too much risk. Sure, you could get lucky. And I know somebody that piled their entire retirement fund into Google stock, and I have another friend that put his entire net worth into Apple many, many years ago, and they've done exceptionally well, but they're taking on higher risk for that return.
They've definitely beat the index.
Yeah.
That's for sure.
And then half of my degenerate friends just live off of Bitcoin only, and they're super rich. So, you know, I don't know. They're to each their own.
That's why I say, yeah, it's really up to your risk tolerance, your age, like what your, capital inflows look like. And so
Your risk capacity.
Yeah.
Remember?
Yeah.
Capacity, that word.
We teach we go into a lot of the portfolio math. There's a lot of surprising outcomes when you look at a portfolio of assets together and how diversification. I mean, it sounds boring, right? You talk about diversification, like blah blah, like sounds like just like boring, right? Put you to sleep. But when you actually look at examples with portfolio math, looking at you put this asset in the portfolio. Oh, you put this negatively correlated asset. It doesn't even have that great of returns, but it's negatively correlated to your portfolio, and you put it in, and it actually juices your portfolio return a ton.
Hell yeah!
Like it's really surprising. So in the stock boot camp, I go through a lot of the portfolio management theory like that, and we even talk about Sharpe ratios and Sortino ratios and wonky stuff like that. But a lot of it just comes down to having some diversification with assets that are not all correlated together. And that gives you shockingly a big boost when it comes to overall portfolio return.
Makes sense.
And reduction of risk, I should say.
Yeah. Susie was wondering why you focus only on high interest debt rather than all debt. For me, so I guess this is a financial planning question for Nikki. For me, this seems a bit more behavioral than only a mathematical exercise. Before I could really turn my finances around, I needed to change my way of thinking and my actions. Any thoughts? So maybe like reframe how what she's asking there too.
She's basically, because I do talk a lot about when you're trying to have healthier finances, pay your high interest debts down first, and then focus on investing.
Yeah.
But Dave Ramsey is out there talking a lot about pay down your house, pay off your house before you invest. That's like his message.
Really?
Yes, and I'm going to do a reaction video to one of his recent videos.
So wait, he's telling people to pay off a 2 or a 3% debt.
Yes.
Before investing in the stock market, which gets 5 times the return.
Yes. Yes. That's
Come on, Ramsey.
exactly what he's telling people to do, and he's got millions and millions of subscribers, and it drives me mad. But I will say this, he's helped a lot of people learn how to manage their money a little bit better, not, charge up credit cards so much and all that. So
sure.
Give him some credit, right? But the reason for that is mathematical, is because the high interest debts are just going to compound against you for a long time, and they're going to cost you a lot of freaking money. Versus the low interest debts, that stuff, you can usually earn a higher return investing in the markets. The average return of the S&P before inflation and dividends are invested is around 10%, right? So the idea is that you make more money investing than what you pay on your low interest debts, like your mortgage.
Yeah.
So that's why that advice of paying high interest debts down is so important, is because it can compound against you. Just exactly, think about how the market, when you invest, it compounds for you, makes you rich. Well, it does the opposite with high interest debts. So mathematically, we want to be thinking about that. But a lot of people do mentally struggle with debt. And they think, okay, I just got to get this debt gone, even if it's low interest debt, like a mortgage. I got to get it out of my hair and then take that money and invest it.
Yeah.
And so I think a lot of this is like working with people on why they're thinking the way that they're thinking. What is it that happened that's making them feel that this is the way that they've got to go? And then, figuring out a way to make it happen for them that makes them feel comfortable. But obviously we like numbers and we like making money, and, that's why that's the way that I present it.
Yeah, it's almost like people, I don't know if any financial guru or whatever is teaching opportunity cost.
Right.
Where it's like your mortgage is at, let's just say 3%, and your stock, crypto, whatever portfolio, if you, here's a range, here's like 20 different baskets, and on average they earn 7, 8, 10, 20, whatever percent. It's way higher than that low interest debt.
Yeah.
The opportunity cost, granted, there's risk there, but like nobody really thinks of the opportunity cost. They only think risk and ultra conservative, and that costs people a lot of wealth.
Yeah, and the other thing is you want to get money compounding in the markets sooner than later. And so Dave is kind of advising people to get their money in the markets later.
Yeah.
And everybody knows that someone who puts less money in sooner comes out better than someone who puts more money in later.
True.
You know, that's just the way the math goes. So, I don't know. Yeah.
It's a good answer.
I don't want to like rant too much, but
I love it. That's what the show is. We just rant.
should we just accept our rants? I could have gone way more ranty on that one.
We need more whiskey too. Yeah. We need to do another whiskey and wisdom. All right, let's turn to the chat. Guys, thanks for popping in questions. Brian was asking, what criteria do you use to pick a crypto to invest in for short term, like 1 year, and long term for 10 plus years? That's a good question. I don't know that I have like a differential 1 to 10 year thesis. First and foremost, I approach every crypto project just like I would any angel investment, any tech startup, any high risk investment. I approach it with, I don't know. Like, I don't know what the hell this thing's going to do. Here's the fundamentals. Here's the value prop. What's my risk tolerance on this thing? That's for an investment, right? I mostly trade though. And before people are like, oh, everybody loses money trading. Like, yes, I get that. Like, when I say trade though, I mean like multi-year cycle trades. I don't just put money in and then forget about it. I actively trade market cycles. So I try to buy low in accumulation periods or bear markets in projects that I think have good fundamentals. And then I sell during hype cycles when prices are high. And I've done that over and over and over since 2013. And that's kind of my core thesis. But as far as like a 1 to 10 year thing, like the only things that I'm completely sold on are Bitcoin and possibly Ethereum. And then some of the Ethereum competitors are looking interesting. Everything outside of that, I use as a trading vehicle to accumulate more dollars or more Bitcoin. And the more dollars I get, the more Bitcoin I can buy, the more angel investments I can make, the more real estate I can buy, the more good whiskey I can drink, you know. So I don't know. I trade altcoins mostly to accumulate other things.
Someone's got whiskey on the brain.
Yeah, I haven't had a good whiskey in a long time. All right.
Corey was asking a question to me earlier, asking about thoughts about the correlation between the Fed balance sheet expanding and index prices increasing. So I think the question there is that about the Fed balance sheet and stock indexes, or is that about the Fed balance sheet and general prices? I think he's saying index.
Sounds like
stock index.
Yeah. That's how that's because a lot of people have said that the Fed is manipulating the stock market and you know, money printer go burr and all of that.
No, I mean, I think that's that linkage. I think we kind of talked about it earlier. That linkage is real to some extent. It's not a 1-to-1 correlation. Like for every dollar of assets that the Fed buys, the S&P doesn't go up a dollar, right? But there's a transmission mechanism that the Fed has always been trying to achieve with monetary policy. So when they lower rates, they want, you know, rates on bonds and mortgages to go down, and therefore, if all yields in the market on fixed income products are going down, it will tend to push equities up and again reduce the free cash flow or dividend yields of equities, just like we talked about with your Apple example. And so there is an obvious correlation there. And you know, the Fed, I don't think their primary objective, certainly their stated primary objective, is not to goose the stock market, but they know that what they do lowers mortgage rates, helps consumer balance sheets. It tends to help asset prices generally. And so they're for sure having an effect. And, you know, ultimately as investors, we have to look at that and not fight the Fed, right? There's a reason why we say don't fight the Fed. You know, you don't want to be short the market when the Fed is trying to support asset prices. So you have to not invest in a world, you have to invest in the world we're in, not the world you want to see. That's why like the gold bugs for 20 or 30 years have been wrong about stock markets crashing, and you should all be in hard gold assets, right? It's like,
should we have a moment of silence for Peter Schiff?
yeah,
Poor guy.
right.
Oh, anyway, sorry.
So yeah, and I'll just say too that there are real companies in the markets doing real things, and their fundamentals are getting better over time. Apple's selling more iPhones than ever, right? So like, it's not just the Fed that's lifting stock markets.
Quickly, can I add
Yeah.
in? You can look at a chart of corporate earnings.
Yeah.
It's gone straight up.
Yeah.
Just like the Fed balance sheet.
Yeah.
Just like the index.
So I think in summary, yes, the Fed absolutely has an impact on stocks overall when it comes to like valuation multiples. But when it comes to like, corporate health and corporate earnings and innovation and selling more products, like, generally that is something that is specific to companies themselves, and hopefully American companies will continue to do that well on a broad basis, right? No matter what the Fed does. So you've got the two components: how well are companies doing, what are valuations that investors are willing to pay for that, and certainly the Fed has a big impact on one of those things.
Great answers.
Yeah.
Awesome. Ramon was asking, do you use Sharpe ratio for your portfolio? Maybe we should explain what Sharpe is and how we use it.
Explain what Sharpe is. You can do it better than
Give
I
us
can.
the mathematical equation without looking at the computer.
Oh. Ooh.
Oh, I mean, the mathematical equation for Sharpe ratio is very simple. It's just the excess return over the risk-free rate of your portfolio divided by
the standard deviation.
There you go.
Yeah, you guys are nerdy.
It's a very
love
simple
it.
equation, and essentially it's trying to measure return versus risk.
Yeah.
How much return are you getting per unit of risk? And so there's other ratios out there too that kind of tweak the formula, like the Sortino ratio focuses only on downside risk versus, volatility on both the upside and downside, which the Sharpe captures. All else equal, right? A higher Sharpe ratio is better. It means you're getting more return for a given level of risk. So a portfolio that returns 50% a year and only fluctuates, small amounts, it only has 10% standard deviation of volatility, then that's a pretty damn good Sharpe ratio, right? Typically anything above like a 1 or 1.5 Sharpe ratio is considered very good.
Yeah.
When it comes to risk adjusted returns. So yeah, I think I don't look at that weekly or even monthly necessarily, but I definitely like to check in on that from time to time and see how I'm doing from a portfolio perspective.
Yeah, and I just pulled up the Bitcoin Sharpe ratio, which is this kind of pink line here, and you can see for the most part, outside of the deep bear markets, like two times in the past like 8 years has Bitcoin been above zero, and most of the time it floats somewhere in between 1 and 3. So, but you can see, over time there is a very big range here. So I don't use it necessarily as a market timing indicator. There's some like on-chain data that I think is much more reliable than this, but it definitely is something that I guess you could look at and just understand that Bitcoin historically has had great risk-adjusted returns over a long period of time. But day by day or week by week, I don't really use it for timing or anything like that.
No.
Yeah.
Yeah.
You wouldn't want to be doing that, right?
No.
No.
I guess you could backtest a strategy and
I
see if
mean,
there's any edge to anything, but I've
it's
never thought of it that way.
Really, you want to be comparing it to something too.
Yeah.
Like when you're
Yeah.
using it, you want to be saying, okay, this asset against this asset, which asset has the higher Sharpe ratio
Yeah.
type of situation.
Yeah. Or when you're looking at adding different asset classes or different assets to your existing portfolio, you could, again, run a back test or look at what would that do to my risk-adjusted returns historically. And it's very useful for institutional investors that are very focused on large asset allocation decisions.
Yeah.
Yeah.
Yep. Yeah, that's a good point. Jay was asking, how do you even manage over 10 cryptos? The headaches with multiple wallets is too much. I agree. I think simple is better, right? Like keep it simple. Less is more. Trade less, profit more. Yeah, all that good stuff.
Yeah, Nikki and I have been trying to simplify our portfolios on the stock side. We definitely, we got a little little aggressive there I certainly did with the number of positions I had in my portfolio. It was really growing beyond a level that I like it to be. I think I was at like 35 stocks or maybe even 38, something like that. And I was like, that's too many to focus on at one time.
Yeah,
Yeah.
that's a lot.
Earnings season was difficult. Ideally, I'd like to be in the 20 to 30 range, maybe even at the bottom end of that range when there's the right opportunities available.
Crypto VC was asking, Chris, what alts do you think are the most undervalued and have the most upside going forward? Oh man, that's a loaded question. Look, right now all I can say is I'm in several positions. We talk about them in our crypto market update. It changes day by day. Right now, most things are not cheap. There have been some really decent pullbacks over the past month or two, but man, that's a conversation for our 2-hour class on Thursday afternoons in the community. Let's see. Oh, wow. We've gone over an hour and a half. We can go ahead and start to wrap it up. Any other questions you guys saw or that you had that you wanted to go over? I know Theo was asking, do you guys ever use bots? If so, what kind? That was actually my wheelhouse. From high school all the way up until like 7 or 8 years ago, I was trading futures and I did everything from fully automated bots to fully discretionary subjective systems and everything in between. Literally in my 20s, spent over 10,000 hours in front of my computer, back testing, developing, not coding, but outsourcing to bot coders and stuff. And I don't like that world. I'm not a quant. I'm not a mathematical genius. I can't really compete in that space with the big quant funds anymore. Algorithms, you'll spend a month building one. It'll be profitable. And the next thing you know, market dynamics shift. And what took so much work now is unprofitable. It's just a very labor-intensive, unrewarding place to be, I think. And the more competitive a market is, like the E-mini S&P today, forget about it, dude. It's dominated by HFT funds. So if you're in there trying to day trade E-minis right now,
Good luck.
good luck, especially in a low vol environment.
Oh,
like
yeah.
the competition's this high, the volatility is this low, and they're fighting for peanuts. In crypto, and really in general, I think our thesis is like ride bigger trends, right? Let trades work over longer periods of time. Don't try to be in there with bots in and out, in and out. You might make money. You might have a lucky streak. You might do extremely well even, but 99.9% of people I know that try to use bots, especially in crypto, get wiped out.
There are a couple of members in our community who have done some interesting strategies with bots. And so,
Yeah.
like you said, though, the question is, how long do the strategies work before they get competed away? And so,
Yeah, that's the thing is like if you're in it full time and you have that desire to constantly be trying to find those edges, you could do it. It just takes a tremendous amount of work. It's not like you buy one bot for $99 and it makes you millions over many
On
years.
TikTok, that's what they say happens.
Yeah. Everybody knows TikTok is the playground for truth, and
They say buy this bot and I'm gonna make thousands a month.
On the stock side, I'm increasingly trying to get access to more data sets and try to use signals in data to inform me, but not necessarily make the decisions for me. So
Yeah.
I'm actually a buddy of mine and I were just talking today. He's got some interesting stuff he's building that will alert me on certain types of SEC filings, for instance. And I have other services that do some like email alerts on SEC filings, but his has an added component of AI that's kind of interesting. And so we're
Nice.
talking about how we might be able to use that to our advantage. But that's more of like the human in the loop type of setup where you have bots kind of assisting you, which I
Yeah.
think is a really cool.
I like that idea.
I think it has a lot of potential. I think we'll see more of that in the future among institutional investors, retail investors, just utilizing automation and data sets to aid them in their trading decisions.
That's a good point. Yeah. The other thing I really like doing is using rules-based trade setups for strategy, where you're not just randomly buying and selling and guessing. You're like, where and why you're buying. and you have specific rule setups that you can backtest. But again, it's not fully automated. You know, there's 3 major pillars. There's TA, technical analysis, there's fundamentals, and there's market sentiment. If you're only using TA, you're missing 2/3 of the pie, right? And so I think it's huge to just use TA, but know its limitations, know the limitations of backtesting, and why, you know, the whole disclaimer of what is it? Past performance doesn't predict future performance. That's actually really damn good advice. It's like, don't just believe that, you know, even on-chain Bitcoin data, what happened in the past does not have to mirror the future, right? It's going to be different. It's like a fingerprint. It might look similar, but it's not going to be exactly the same.
I like to have control over my investing and trading.
Yeah.
I'm too much of like a control freak with that stuff. So
you just want to make all the decisions.
no bots for me, but I'll take a bot like helping me like with earnings reports or with SEC filings or things like that. I'll take that.
Yeah, good luck with all that stuff. All right, guys. Well, we can go ahead and wrap it up there. I know we went for almost 2 hours, so thanks for hanging in there with us. If you guys want to join our community, I'll throw the link up here on the chart. It'll also be in the description, wetalkmoney.com/community. Come hang out with us in our Discord channel. Come to our live market update classes, see watch lists, alerts, all that good stuff. We've also got some courses in there on the mental game, on financial planning, on
stock fundamentals,
Yep.
on crypto basics. So that's what we do on a daily basis. If you want to come hang out with us. If not, hopefully we'll see you next week too. Thanks to Kevin in the background for doing this. Thanks to White Charts for sponsoring the show. And I'm going to leave us with a quote. And yet, Bitcoin lives on.
Your favorite
I was waiting for that
ever.
the whole show. I was waiting for that.
That was an epic ending.
Oh, I love it. Yeah, no matter what the regulators decide to do, Bitcoin and crypto are going to keep moving. The only question is the U.S. going to get left behind? I sure as hell hope not. Please don't.
No.
Oh, man. All right, guys.
Thanks, everybody.
Yes, thanks for joining.
See y'all
See you
next
next
time.
time.
Later.